Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, yield nerds, I thought I would share a devastatingly simple roadmap to spot equity diamonds in the rough. And I give my salute to Roaring Kitty, who clearly has taken the internet world of investing by storm. And I am more like the little crawling turtle next to the Roaring Kitty. Having said that, we are at about 300 something subscribers in a year and a half. If you're new to the show, please use the income investing roadmap, which lays it out in sequence. And remember, I am no Roaring Kitty. I do not have powers of prediction, and so please do your own homework on anything you see here. Speaking of Roaring Kitty, we'll go take a quick market temperature check, and I will introduce the crawling turtle. And this is no Roaring Kitty. And we're going to go after value stocks and see what we can understand there and see if we can create a methodology to spot diamonds in the rough. Well, how are the markets doing? Quite simply, they are on fire. And the last couple of weeks have erased everything that happened earlier. And you have to sit around and say, if the last month is the same as 9 months of returns on the fixed income market, should we all chase the next fad? Should we all look at growth? I don't know. GameStop, for example, up 223% in the last 5 days. The PE ratio of GameStop is a very humble 2,363. Sounds lovely to me. Nvidia looks cheap compared to that, and there must be some amazing growth for GameStop that you and I don't see. And so good luck if you bought it. I hope it works out for you. My crawling portfolio in the meanwhile is up 0.5%, and I keep plodding along. That's me. But the reason I have that steady upward trend, as you know, if you have watched this earlier, I am north of 99% on fixed income. And within fixed income, I'm mostly on treasuries, which are short term. And so, very different ball game, but I do dip my toes in equities. I do try and understand value stocks and value investing. And that is where I thought the crawling turtle would introduce itself to the Roaring Kitty. I can't do 228% in 5 days. That's amazing. Good for that group. And if this Roaring Kitty analogy does not ring a bell, you should watch Dumb Money, the movie. And the gentleman from Dumb Money is back, and he's creating a stir with short sellers. And, good flick. Speaking of which, I want to make sure that everybody here understands I'm not a wealth management advisor. I do not short any stocks, not my jam. And I also am not pitching any product, and I don't endorse people, politics, none of that stuff. So let's go back to value investing and how to identify a value store. I rely on fundamentals, and that means the first thing I do is try and remove risk. I take away currency risk. There were some comments from a couple of people on stocks in China. I don't understand the Chinese market much, and I am too chicken. I'm a crawling turtle. And so for those of you who want to take that kind of risk, good luck, not me. I do look for high trading volumes, so the spread is lower, and I look for price to earnings ratio and keep it at a very modest 10, 15, something like that, not 2,363 like GameStop. I look at price to cash flow, and the idea being you want to look at the cash flow of the company and pay as little as possible. I look for low debt, high return on investment capital, and the most important area where I spend time on is micro and macroeconomics. Microeconomics is where, is there a substitute for this? If the price of salt goes up, are you going to eat food without salt? Or if one brand of salt increases their price by 5%, will you even notice it? And so that is the microeconomic side. If gas prices go up by 10 cents, are you going to start walking everywhere? Probably not. And macroeconomically, you may find this one horseshoe maker who can increase their price of horseshoes by 5% or 10%, but not a great growth market. And so you have to look at the world and say, is the horseshoe industry where I want to be? And so my pride and joy is in reading material that gives me information on substitutes and macroeconomics. And then I look at competitive positions. Are they a dominant player in their market? And are they likely to be acquired? Encore Wire is one that I bought and eventually they got acquired and I sold it at the price they got acquired. So I'm very happy about it. So those are things I look for. And I very humbly believe there is a slowdown in the economic temperature coming. And so I look at which stocks are poised to take a beating and I avoid those as well. And the principle that I wanted to talk to you about today is really expanding the search. Because we talked about the equity Super Bowl and the yield Super Bowl. If you only bought treasuries and if you only bought TeeKay Tankers, that's all well and good. But then you're not going to put all your capital in that one area. And so what I started doing is I start from the Value Magnificent 7 filter. If that is new to you, you should watch some prior episodes. And then said, okay, who are the other companies in the same industry? And who are the other companies that may meet some of the filters but not the others? And then start looking at where do I go from there? So let me take the Value Equity Super Bowl winner TeeKay Tankers. They are in the middle. And then you start looking at TeeKay Tankers as a tanker company. Who are other tanker companies? And then say who are companies that met some filters and not the others. So let me give you an example. This is from episode 120 of this same show. TeeKay Tankers said, hey, we're opening new pipelines and that oil needs to go all the way. And TeeKay Tankers is an Uber for oil, as I kind of used a simple analogy. And they said this pipeline alone is going to have a demand for 25 to 30 Aframax tankers. And just a quick primer on tanker sizes. There is the ULCC and the VLCC, which are obnoxiously long tankers. They go in the wide ocean. And, pardon me, the Suezmax is the largest tanker that can go through the Suez Canal. And then the Aframax and the coastal tanker is the baby. And that goes up and down barges, that goes up and down rivers, and these go to the inner areas, the canals, and so on. And if you look at TeeKay Tankers fleet, you can see that it's Aframax, Suezmax, and VLCC. And so their smallest tanker is 100,000 deadweight, and the largest is 320,000 deadweight. To put it back in that scale, if you go 100,000 and up, you are Aframax, Suezmax, VLCC, ULCC. This is where TeeKay Tankers lives. They don't mess around with the minnows. And you go, interesting. Who messes around with the minnows? What kind of business exists there? And that's what I mean by looking at adjacent markets. And so I started digging at who are the companies that play in that area? What kind of margins are there? And I'm giving you the suspense. TeeKay has a baby sister. And please remember to use your own research and your own judgment. And that baby sister is called Ardmore Shipping Corporation. ASC is their ticker. They have 16 ships. All 16 are under 50,000. So they're all the little coastal tanker babies. And you look at the stock performance and you have to rub your eyes for a second. The last 6 months, Ardmore has gone up by 67%, while TeeKay went up by a mere 38%. Thank you, TeeKay. And you then say, okay, how about the last 3 years? And they both have more than tripled. And you go, interesting. Let me understand more of this. So I put them both in a head-to-head match. Ardmore's 10K and 10Q indicate that they will take 30% of their cash flow and give it away as dividends. That is their jam. So it's a very high dividend company. And in terms of profit margins, TeeKay edges out Ardmore. In terms of debt, Ardmore doesn't really have a lot of debt. And the reality here is you can look at every one of the key metrics. TeeKay is still world class. Nothing can touch it. And Ardmore is not shabby. And you look at earnings per share, look at this nutty comparison. TeeKay is 5 times the earnings per share. TeeKay is cheaper than Ardmore in terms of price to earnings. And so again, TeeKay is a class apart, but they do not participate in the coastal tanker segment. Apparently, that's not a very profitable segment. As a matter of fact, sales has not increased. The reality I do look at is when there is an economic slowdown, and this is what I mean by microeconomics, macroeconomics, and economic slowdown, the really large tanker demand may drop, the really smaller one may increase. And so you have to use your own judgment, obviously. But when you look at gross profit margins, you can see that it costs more for Ardmore to operate. And so I'm kind of paying a lot of attention to this, understanding Ardmore. But from what I can see, they are a really good company, just not as good as TeeKay. And so you take a look at the entire stock, and they don't really have a whole lot of debt. My assessment is that TeeKay Tankers is still a much better company than Ardmore. However, they play in different lanes, and economic slowdowns may drive more business towards Ardmore. So I did open a small position in Ardmore. Please make sure you use your own judgment. Then I went to my next all-time favorite, CalMaine Foods. And you may remember with CalMaine, we looked at adjacent companies. We actually looked at a company called Vital Eggs. And Vital Eggs sells extremely pricey eggs. And, when it comes to an economic slowdown, my humble opinion, I did not go towards Vital. But then I said, are there other foods? It may not be eggs. What are the other commodities where there is a dominant position that can be built? And, I enjoy my coffee. I'd love a product placement. This part of the show is sponsored by a coffee maker. I don't have sponsors. But I noticed that the price of coffee is skyrocketing. Look at that. And that price, with a little bit more lift, will be at an all-time high, a 15, 20-year high. And so it really intrigued me and said, if the price of coffee is going up, who benefits? As I said, we can look at inflation as an enemy, or we can buy specific stocks to capitalize from that. And for those of you that followed Starbucks, you will know that Starbucks pretty much crashed and burned with their previous earnings report because they said people aren't buying the $7 cups of coffee. How strange. And then the question is, if price of coffee is going up and Starbucks sales are going down, they did not say they lost money on coffee for futures contracts. That wasn't where they lost money. People aren't coming to Starbucks. So I started doing research and said, gee, what is happening? And I first want to remove a rumor. There is a rumor, if you Google coffee, inflation included, there are many articles that say, oh my God, the Fed is changing rules. Coffee is no longer factored into inflation. That's why we think inflation is not, going up, when in reality, coffee prices are increasing. That is incorrect. There is a category called 717311 where the CPI does include coffee, except what the Fed said is the sizes of coffee are so variable that they can't say small bags of coffee, medium bags of coffee, big bags of coffee. They just created a new category to combine all the coffee sizes, except it is reported as a price per pound when it is included in the CPI. And so, just as an aside, it is still included in inflation, which also, in my opinion, means somebody is making money. Who is that, and how can I, as a yield nerd, identify them? So I started looking at Starbucks, and I said, okay, they lost when coffee prices went down. Who is winning? And the number two player is Keurig Dr. Pepper. And I said, ooh, this is interesting. If Starbucks is losing, maybe Dr. Pepper is the winner. And so I started digging deeper into Keurig Dr. Pepper and looked at their annual statements. And I was astonished to note that Keurig Dr. Pepper has 125 brands. Absolutely stunning. They own many, many coffees. They own many, many soft drinks. They also own Mott's applesauce. What an odd assortment, but those are the things they own. And so I said, I am looking for, and their coffee revenues are 70% of their total revenues, which is stunning to me. And so I was very excited. I was looking for a huge jump in their coffee revenues, because if people are running away from Starbucks and they're going to use Keurig pods to make coffee at home, Keurig Dr. Pepper Nice. Did you increase your sales? And the answer is no. I'm incorrect about 70%. 50% of their revenues or something to that effect is from coffee. And you can see that their coffee sales actually went down. And you go, what the hell is happening? The price of coffee is increasing, but people aren't drinking more coffee. They're drinking less coffee. So maybe coffee is not as price elastic after all. So if price elasticity means when the price of coffee goes up, people just say, I'm going to drink fewer cups, I'm not going to drink more. That is what appears to be happening both to Starbucks and Keurig. And to kind of reconfirm that, I started looking at the individual Keurig pods. And you can see that in last year, first quarter, they sold 771,000 Keurig pods. They increased the price of Keurig pods, and people say, I'm just going to drink fewer Keurig pods a day. And the thing that I then said is, oh, maybe more people are buying Keurigs and they're going to make it at home now because Starbucks is losing money. And I do see some marginal improvement. Last year, same quarter, they sold 125,000 Keurig, the machines, the appliances, and there is a really small improvement there. So nothing jumping out. Keurig is not the big winner. And so I said, gee, I wonder who else is. And Starbucks is losing market share. Keurig is losing market share. And the rest of the companies, unfortunately for me, and you do you, Nescafe is not based in the US. McDonald's has also said they are losing, people aren't buying their $19 burgers or whatever they're getting bad press for. And I looked at the rest of the top 10 coffee brands, and they are not US based, and I do not invest outside the US at this time. And so you do you. I was curious about Folgers, which is a US brand. The challenge with Folgers is coffee is a really small piece of their portfolio, and SJM, which is their ticker, didn't have a much higher revenue either. So I didn't know where to go. But if you have a clue as to where the coffee sales are going up, I would love to know. So here is my devastatingly simple roadmap to picking the next stock. My devastating simple roadmap is to simply not chase fads. I do use my filters. I buy a stock if it matches it, and I do sell stock if it falls out. TeeKay Tankers, to me, is a wonderful investment, but if it falls out of my filter, I will sell it. I'm starting to look at adjacencies, companies like Ardmore. I don't pretend to think that the stock sells at 17, it's going to be 23. I have no idea what the stock price is going to be, but I do spend a lot of time on the micro and macroeconomics. And so my next steps based on this information, here is my portfolio. TeeKay Tankers is absolutely crushing it for me. CalMaine Foods and the rest of them are where they are. I did open a really small position in Ardmore Shipping Corporation. I'll start understanding them more as time goes on. Outside of that, I'm just buying treasuries. You do you. Thank you for listening, and we'll see you in a week. And remember, even a broken clock is right twice a day. Remember to do your own homework. Thank you for watching Yield Nerd. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.